Hello, hello, hello. It's my Beasley. And listen, I've got a question for you. Boy, do I have a question for you. Did you know that starting in 2026, Secure 2.0 quietly and substantially will change how Americans save for retirement? So we're going to continue the discussion on what Secure 2.0 is, okay? Now, let me tell you, this topic is very meaningful to me because if I were still in the workplace, it would impact me also, okay? Especially with the first 2 points I'm about to walk you guys through. I wasn't a huge supporter of 401k plans, and I'm still not. Okay, I do believe it has its place, and I will talk about that in a whole nother episode that I'm definitely going to bring to you guys, so you'll know about the 401k plans. But so let's get back to the new law, the Setting Every Community Up for Retirement Enhancement 2.0 Act of 2022. That's a mouthful. Okay, hence why it's better known as Secure 2.0. Now, this act was signed into law on December 29th, 2022. And while the financial industry talked about this, right, most everyday Americans never had a clear explanation of exactly what changed, right? And so here we are now in 2026, where most of the changes are taking place. And you can go back to episode 2, where I actually discuss how they're rolling the act out in phases. Let me drop this into your spirit. Luke 14:28 says, "For which of you, intending to build a tower, does not first sit down and count the cost?" Well, guess what? That's exactly why smart planning matters. Building your financial portfolio requires planning, and planning is stewardship. You don't build without counting the cost, right? That doesn't make sense. So here's what you need to know. Let's break this down. Secure 2.0 was created to help people save more. It was created to help them save earlier and save consistently. And I love that for you. I love that. However, there are some helpful updates. The truth is this: more rules don't automatically create better results. Okay? In some cases, they create more confusion, right? That's why it's important to understand the key points of the law. Here we are with point number 1. Section 101 of the law now requires automatic enrollment and automatic escalation for most 401ks and 403 plans. So basically, if you don't enroll yourself, you're automatically gonna get enrolled anyway, at no less than 3% and no more than 10% of your pay. It doesn't stop there. Did you know that every year after that, your contribution will automatically increase by 1% until it reaches at least 10% and up to 15% unless you actively opt out? And honestly, I don't know what that opt-out process looks like. We're still researching that. Like really what hurdles you have to go through just to opt out. And because no one's talking about it, it really makes you wanna say, like, wait, what else aren't they telling us? So now the government is essentially saying you are going to invest, and you're going to invest more every year. Listen, savings is important, But this also means less take-home pay for you automatically. And this is why Proverbs 27:12 speaks so clearly here. The prudent see danger ahead and take refuge. Listen, automatic enrollment and automatic escalation sounds helpful, but if you don't understand what's happening to your paycheck, you can't steward it wisely, okay? And that's really the point I'm trying to make. Saving for retirement is absolutely important. And you should be doing this in your 20s and your 30s and not waiting until you're in your 50s and then having to play catch up, okay? But when things are forced on you, you lose the ability to decide what actually works for your family, for your life, for your financial plans and your future. When money is taken out automatically, your take-home pay drops, and suddenly you feel like you can't afford anything else. That tension is what no one's talking about. And for new employees entering these new plans, that's exactly what they're going to have to manage. Listen, the solution isn't to stop saving, right? It's taking control so you can direct your dollars into a plan that grows for you, a plan where there is no market loss but protects you and actually fits your life. So opting out can be a good thing, right? I'm not telling you that, but opting out doesn't mean you're not saving. It means you're choosing to save in a way that fits your budget, your goals, and your overall financial plan. That's stewardship. That's control. I am so pro-choice. I am so pro-clarity and so pro-stewardship. Point number 2 deals with catch-up contributions. Okay, Section 603 changes how catch-up contributions work. And for many people, they now have to put their contributions into a Roth. So let me now tell you how the new rule is impacting us 50-plus-year-olds who are earning $145,000 or more. Yes, I just told you my age and what my salary was when I was in corporate America, right? So as I mentioned earlier, this is one of the 2 areas where Secure 2.0 would have impacted me personally. So basically, it is age and becoming a high income earner, and the automatic enrollments would have impacted me. Section 603 now says that catch-ups must now be Roth for high earners. If you're 50 or older and you earned $145,000 or more in wages from your employer in the previous year, which was indexed for inflation, your catch-up contributions can no longer be pre-tax. They must be Roth. Now, some people ask me, Mike, is it a bad thing that high income earners and 50 and older now have to make their contributions as Roth? And listen, it's not automatically a bad or a good thing, okay? It's just a shift, right? And shift requires strategy. Because here's the truth. For a lot of people, this change will feel like a loss. Why? Because now you're paying taxes on the money today instead of deferring it. You lose the tax deduction. Your take-home pay goes down and you no longer have the choice between pre-tax and Roth. The government made that choice for you. And let's be honest. Most people in their 50s are in their highest earning years, which means highest tax bracket. So forcing Roth contributions at the most expensive tax point in your life, that's not automatically wise. But flip side, Roth does have benefits. Tax-free growth, tax-free withdrawals, and no RMDs on Roth 401ks, which started in 2024. So again, it's not bad, it's not good, it's a shift. And shifts require strategy because the taxes you're paying on that money now, yes, you're losing upfront tax deductions. Yes, your take-home pay goes down. which means your retirement strategy may need to be adjusted. Okay, so while the headlines say catch-ups are increasing, the fine print says if you are a high earner, you're paying taxes on those catch-ups, whether you planned it or not. Okay, for some people, that's helpful. For others, it's a surprise and not always a pleasant one. And for many families, it doesn't solve the core issue, which is not having a strategy in place to begin with. And this is why Luke 14:28 matters. We are called to sit down and count the cost. So if you're 50 plus and earning $145,000 or more, this change affects your taxes, your take-home pay, and your retirement strategy. Counting the cost isn't optional, it's stewardship. So let's move on. Third point I want to make deals with student borrowers and how they can get employer contributions. A good idea, but only if the employer chooses to offer it. Point number 4. Now, the new RMD, required minimum distributions age, will eventually rise to 75, but that's not until 2023. So I'm not going to spend a lot of time on that today, but I do want you to be aware of it. The RMD age is now 73, and it will increase to 75, like I said, in the future. On the surface, this sounds like good news. More time for your money to grow. And yes, the shining star, if there is one, is that the IRS penalty for missing an RMD dropped from 50% to 25% and even 10% if corrected quickly. Let me quickly explain what that means. If you miss RMD, the IRS now gives you a chance to fix it. If you take the amount you were supposed to take, even though it's late, you file a form and then, within their time frame, then the penalty drops from 25% to 10%. And I know I said I wasn't going to talk a lot about this, but here's the part most people miss. Delayed withdrawals mean larger account balances later. Larger balances mean larger required withdrawals. Larger withdrawals mean larger tax bills, and that can push retirees into higher tax brackets in their late 70s and their 80s. So even though the penalty is lower, the tax impact from forced withdrawals can feel just as heavy, sometimes even heavier. This is why strategy matters, okay? So the real takeaway with RMDs is simple. Don't miss them. Take the withdrawal when you're supposed to because it triggers penalties, even though Secure 2.0 reduced them. Moving on. Your employer is offering these plans to you. Yes and yes? Yes. And why? Because some of us do in fact need help in savings for our retirement. But please know that employers get benefits for offering these plans. This is the part most people never hear. Employers receive tax credits for starting new plans. They get tax deductions for the contributions they make, the match, right? So Secure 2.0 increased incentives to encourage more employers to participate. So while it's presented as helping workers, the truth is the government is helping employers help themselves, and employees get swept into the system by default. Again, this is why understanding the rules matter. And it's just to be clear, the automatic enrollment under Secure 2.0 is really only for new plans and new employees. If you've been at your job for years and you've already chose not to contribute, you're not suddenly going to be enrolled. But you should still be saving, absolutely. But save in a plan where your money is growing tax-free and you are protected. So bottom line, yes, Secure 2.0 will change the rules, but rules alone don't build financial security. Understanding the rules and having a smart strategy, a smart plan is what makes the difference. As Habakkuk chapter 2 verse 2 reminds us, write the vision, make it plain. So understanding these rules is part of writing a clear financial vision for your future. Now remember, before you can build anything, sit down and count the costs. Secure 2.0 is part of counting the costs. Here's what I want you to do. Take a few minutes this week to review your retirement plan and ask, do I understand how these changes affect me? Clarity is the first step towards stewardship. And if you would like a complimentary personal financial review, let's talk. I'll be happy to assist you. Be wise, be intentional, and stay tuned for more financial literacy episodes, especially one where I'm going to break down that traditional 401k plan versus another type of plan that is smart and truly positions you for retirement. Until next time, keep moving forward one smart choice at a time. Make sure you subscribe, like, comment, and share this video with others, and turn on notifications so you never miss a value add moment. May the Lord bless you and keep you, and may the Lord make his face shine upon you. Be blessed and be a blessing.